Welcome everybody. Good afternoon. My name is Joe Stapleton, and it's a pleasure to be here with you guys. I am the president and co-founder here of Spinnaker Investment Group. We appreciate each of you making the time to be here. Today, the goal is to have a meaningful dialogue about the investment markets and our philosophies about investing. We've got over 100 clients joining us today. We're going to be recording this. We're going to post this on our YouTube channel early next week. Today, we're all about education, knowledge, and really turning off the noise that's out there in the world right now. You talk about COVID, the election cycle, anything going on right now in the media, but we want to kind of take away that and show you what we've got going on from an education standpoint here at Spinnaker Investment Group. So today, we've been founded over 4.5 years ago with the principle of improving the overall client experience. It's incredible that as we move into 2021, we are now managing over $420 million. That wouldn't be possible without the support from you as our clients and our valued partners. We continue to invest in technology and certainly planning tools as well. So the format for this afternoon, we're going to start with the 2020 review and looking forward. We're also going to do US international stocks and then fixed income, talk about some economic trends, market conditions, and certainly opportunities that we see out there in the marketplace. There's a question and answer feature down at your bottom of your screen. There's also a chat feature. So I'll be monitoring all of those. So if you have an opportunity to ask a question, I will be happy to cut off Morgan and answer those, ask those questions directly. So feel free, and if you have a question, you can also raise your hand and we can go from there. So, but before we get started, I certainly want to spend a moment to introduce our newest team members. We've had a tremendous amount of growth here at Spinnaker. I want to start with our very own Nicole Naughton. She's our portfolio administrator. She's head of operations, client services. She graduated from Loyola. She spent a number of years at ASICS in the marketing department. She's an avid surfer. So Nicole, go ahead and say hi.
Hi, everyone. I'm super excited to be part of the Spinnaker team, and I look forward to working with all of you.
Terrific. Thank you. We're happy to have you. All right, up next, we've got Riley Hayes. He's a financial advisor here at Spinnaker. He's certainly a local celebrity. If you haven't seen Good Morning Newport, he's certainly fun to check out. He's a graduate from Chapman, and he's responsible for all the film production here at Spinnaker with all of our social media videos. So welcome, Riley.
Hello, everybody. I'm honored to be part of such a dynamic firm and happy to help you guys out however we can.
Terrific. Thank you. Up next, we have Annika Wilson. She's one of our newest financial advisors. She's a graduate from Pepperdine. She's a Division I volleyball player. She participated in many NCAA championships. So we're very excited to have Annika, and welcome to Spinnaker.
Hi, everyone. I'm super excited to be here, and I can't wait to meet all of you soon. Thanks for the introduction, Joe.
Of course. Thank you. Welcome. And then Nikki Wood. She's our newest. This is part of the growth within Spinnaker. She's going to be our newest team member. She's going to be dealing with client concierge. So for those of you who have any questions or have more information or whatever the case may be, if you can't get a hold of us, she's going to be your contact person here at Spinnaker as well. So welcome, Nikki.
Hello, all. Thank you, Joe. I'm excited to be part of the Spinnaker team as the client concierge, and I look forward to meeting you all and helping you with whatever needs you may have. Thanks.
Fantastic. We're excited to have you. All right, terrific. And some continued long-term members of our team. I wanted to give Gerald a moment to introduce herself. So Gerald, welcome.
Hi guys, this is Gerald Tudio. I'm the insurance consultant for the team, and I specialize in life, health, disability, and long-term care. And this is my 3rd year at Spinnaker. I'm so excited to be here.
Fantastic. And then Anthony Puma, been with us since day one, another financial advisor here, and he runs up our Northern California office. Puma.
Thanks, Joe. Anthony Puma. It's been an honor to be part of such a great team of individuals since 2016. I've known some of you much longer than that. And just really looking forward to a wonderful future 2021 and building and growing our practice together. Thank you very much.
Fantastic. Thank you. And then we've also got our vice president, another partner here at the firm, Andrew Krongold. You'll hear from him later. So we're excited for all the growth. Obviously, you've met some of our new team members here, and we can't wait for another successful and incredible year here in 2021. So now the moment you've all been waiting for, our very own Morgan Kristen, known affectionately as the Wizard here at Spinnaker. He's our CEO, CIO, co-founder as well. He's a CFA, CFP. He's been doing this for almost 28 years now, but certainly we're very excited to give a warm Spinnaker welcome to our very own Morgan Kristen.
Thank you, Joe, and thank you all for joining us today. Happy to be here in 2021, and hopefully we're putting everything behind us here shortly. So we'll be talking about the market, obviously, and talking about what we see going forward. But I think a couple things I learned from last year is that I can't stand the words unprecedented and new normal. So we certainly hope that 2021 is normal, but we're definitely tired of those terms. So, okay, so let's just launch into it real quickly here. So we are giving a market update. Let's talk about what happened last year. So certainly 2020 was a year that, you know, a lot of people thought that was going to be kind of a mellow year as far as returns at the beginning of the year. And then all of a sudden we had the COVID hit and we had a massive drop in March. But markets certainly staged a heck of a comeback. And you look at the final quarter was really a surge in a lot of markets. And then you see the 1 year there, US large stocks, when you look at the S&P 500, finished up 18%. But when you look at even small caps, a lot of people weren't in a lot of the smaller companies. They actually outperformed the S&P 500. So, you know, certainly interesting times. International did well, even emerging bonds did well. Interest rates went down. When those values go, interest rates go down, bond values go up. And then at the bottom there was real estate investment trusts, right? So everyone started working from home, offices were hit pretty hard. And so real estate investment trust in general were certainly hurt. But, you know, as we'll talk about later, some industrial real estate investment trusts work well because, you know, they're selling stuff to Amazon. There's also real estate investment trusts that have cell towers and stuff. So in general, though, the real estate investment trust as a general category did poorly. So breaking it down further into, you know, just general markets, start looking at large and small, you know, large, when you look at large growth, when you look at the Russell 1000, that did outperform the Russell 2000. But I think what you want to look at here, and I think that to me, what I see is the disparity now with growth and value. So just in the last year, the huge difference between growth stocks, you know, all your tech companies and your value companies, that's oil and banks and industrials. And that's really been going on for quite some time. Historically, there was a value premium. Owning value stocks had a premium, but over the last 10 years, there certainly hasn't been a value premium. And a lot of that is the excessive returns that we've seen in the large growth space, especially with technology stocks. Now, further breaking that down, it was a kind of a tale of things that were open and things were not, you know, that helped COVID and things that were hurt because of COVID. So online retail absolutely crushed it, home improvement, groceries, industrial REITs, and at the bottom you had your energy and airlines and hotels and banks and all of that. So really you can see the push here by certain sectors really help the markets in general, because there is still quite a few areas that are down. And this will be part of what we're talking about too, because a lot of people say the market is overvalued, and certainly in some areas it is, but you can see that not every part of the market participated last year. International, basically the same type of story, growth companies outperforming the value, but we also marked it in you can notice in international that the lighter color there is in their local currency versus when you repatriate in the darker gray to US. So the dollar was hit a bit, and so, you know, certainly in 2020, a US investor did a lot better in international growth stocks than the folks that are in their country. The currency trade was added about 8 percentage points, well, 7 percentage points over that time just in growth. That's 11 minus the 18 there. But you can also see there too, for some time, there's been a disparity in the growth and the value, with growth certainly over the 10 years outperforming it. And, you know, a lot of people don't own international stocks. And when you look at the last pullback in 2009, or I should say last recession, US stocks certainly did well and moved forward well. International, yeah, it's done okay, but nowhere near what our domestic stocks have done. And so if you look at valuations, you can look at a price earnings ratio. How much am I paying for $1 of earnings? And you look at non-US stocks, they're cheaper. 20 instead of 22, they're trading at about 16 times with actually a better dividend yield. So we certainly recommend, and we'll talk about this later, that international stocks be at least a part of someone's portfolio. Emerging markets, same story here, growth over value, and we'll get into all the different countries and see how they have performed. But emerging markets had a heck of a run last year, and a lot of that is what they call the beta trade or the risk trade. A lot of people said, I think I'm going to start going into these because they were beat up for some time. And you can see here, I mean, especially in value and other than growth, these stocks have really not done much over the years. So looking at different countries, Denmark, Sweden, Netherlands, and Finland are at the top, with the UK, Singapore at the bottom. And that's for developed countries. With emerging markets, you have Korea, Taiwan, China at the top, Egypt, Brazil, and Colombia. So you look at some of the bottom emerging markets, and a lot of that had to do with the oil trade. And that certainly makes sense that those stocks or those countries did not do well. But I think beyond that, you can see that the reason why you do want to have some money in international, I mean, that's the Denmark, and granted, I'm not saying go out and buy Denmark stocks, but you look across the board there, and at least in the developed markets, the majority of markets were up and positive. So some of them outperforming our US markets. Currencies, just to see what happened there, that goes into some of the trade. The Swedish krona at the top, Hong Kong dollar at the bottom. In the developed countries and emerging markets, you saw the new Taiwan dollar at the top, and Argentine peso, Brazilian real. Again, some of the oil trade there at the bottom. So looking forward, you know, we all had the US, the Eurozone, emerging markets, we had negative GDPs in 2020, but looking out into the future, and these are certainly guesses, but this is where the consensus is as to where the GDP growth will go. The US is projected to be about 3.1, the Eurozone 5.2, and emerging market GDP at about 6%. So certainly some opportunities in the Eurozone and emerging markets. And so again, look at your allocations and see if you have any international holdings. Talked about real estate for a bit. Real estate investment trusts, both globally and domestically, certainly did not do well last year. And you can see here that really over the years, this year really crushed them. In fact, you know, their 3.5 was not so great, although the 10-year wasn't horrible. You know, assuming that 7% rate of return over those 10 years, that those assets did double. So it doesn't mean abandon that, but certainly not a great year over the last few in real estate. Commodities, this is, you know, I always look at this. I mean, people look at gold and certain commodities in general, but when you look at the basket, it's, you've lost 6.5% per annum in commodities. But, you know, you look at this, last year was clearly the oil trade, West Texas, natural gas, heating oil, all not doing so well. What it's encouraging though is when you see copper and silver, that's all used in manufacturing. So it's good to see those numbers up. So those numbers, of course, have done quite well, at least for 2020. Now, getting into oil, oil has been for a while on this long slide. In fact, last year we touched 11.57 a barrel. We actually went, you know, that trade went negative for a bit as the one of the big ETFs, USO, basically when you do a futures contract, you have to take delivery. You either sell that contract or you take delivery. And so that giant exchange traded fund was going to have a big shipment of oil coming its way. So it was happening in April. No one was buying oil. And so they ended up selling it, actually giving someone money to take their futures. And so oil really dropped, hitting a low, at least at 11.57, but has since bounced back. What I'd like to focus on though is in here. You know, we have the barrel inventory, and then we have the rig count. And really, when you look at, you know, if you're someone who wants to look at trends and where things are going, and you look in the future here, when the rig count dropped as we went into 16, it dropped here and then dropped again. You notice right in there that's where oil started moving up. So rig count again dropped, and so that's why we're seeing oil bump up again. So it's not easy to get rigs up and running again. So, you know, that you have a classic supply demand issue there. So as this economy opens up, these rigs cannot come online right away. So there certainly could be some higher prices in oil. And, you know, some of this could be somewhat inflationary, but we think because the rig count is down that you should see some continued strength in oil and gas. Fixed income bonds, you know, basically we went from the beginning of the year in 2020, that's where rates were, you know, and these kind of almost like 2% across the board, and then just a big drop from the third quarter to the fourth quarter. Rates really went nowhere. So rates are still very, very low. And I think what the Fed is saying here, this is the Fed dot plot, they don't anticipate going anywhere with rates for some time. I mean, we shouldn't see anything, at least from what they're saying, till 2023. So not a great area to be in as a saver. Expect CD rates, money market rates, and all of that to stay low for some time. So last time we had someone asking about, you know, we're talking about bonds right now and what the government's done and where interest rates are. And so we want to talk a bit about debt and the debt accumulation. So the spending, federal 2021 federal budget looks like this. I mean, you look at about 50% of it, it goes to Social Security and Medicare. That's a big part of our spending. So where does the income come from? Well, mostly it comes from income taxes. That's personal income taxes. You'll see here, this is corporate. Corporations have never been big taxpayers, so a lot of times a lot of politicians talk about raising that rate, but frankly, it's never been a big number. Money generally comes in from Social Security and income taxes, and then the fill number, the plug, and that's our borrowing. So there is a plan to borrow 1.81 billion. So to fill our budget, we continue to borrow. So looking at that heavy debt load, you know, reasons to fear that. Well, it's obviously as an individual, it's better to, or even a country, it's better to have less debt than more. You really generally want to keep your debt to GDP pretty steady, and we certainly have not done that recently since at least 2007. When it piles up year after year, it reduces the government's ability to stimulate, and which generally triggers inflation. But some reasons to chill, I guess, at least for now, is we are the world's largest economy. There's a tremendous amount of our dollars held by other central banks. Exports, imports, all priced in dollars, as is oil. Rates are low, and from what we saw earlier, the Fed is really saying that, I mean, they've come out and said they're not going anywhere until 2023. So those low rates allow the debt payments to actually be pretty low. Inflation has been pretty constant, even with these rising debt levels. So, you know, that you talk about in the past, you'd be troubling because it said inflation would go, but since the early 90s, inflation has been pretty steady, and the debt has been tacking on, especially from 2007. So conventional wisdom states that countries in trouble if its debt exceeds 100% of GDP. Well, we're there. We're going to, I think I showed there, you know, we're at 100% in 2020 and projected to go a bit higher. But you look at Japan, they have, I mean, they cannot get any inflation. They're at their debt is 266 times their gross domestic product, and there is virtually no inflation in Japan. So if they're a model, we're certainly following that, and we haven't hit that inflation even with the debt. And this is not to condone all this debt we're taking on, but it's just at the present time not a major issue, and the market doesn't see it that way, and where you might want to invest later. M1, M2. So this is money supply. This is your checking accounts, your saving accounts, your CDs, money markets, things like that. There is a tremendous amount of money that is sitting in everybody's banks and checking accounts. There's a lot of money. That's a good thing, and we'll talk about that in a minute. Now, we're seeing all that money, but we're also not seeing the velocity of money. Money's not spinning through the system. So we are keeping inflation low. So yes, there's a tremendous amount of money out there, but it's not pushing through the economy. It's not duplicating itself. The consumer, we're all in pretty good shape here. I shouldn't say we all. In general, the consumer is in good shape. So our last peak in total assets was in 07. We peaked out at 85 trillion. Today we're about 140. Financial assets, our home, where are our debts, or our expenses. Mortgages are the biggest part, but rates are certainly very attractive there. One thing of concern is as student debt continues to climb higher than auto revolving and revolving credit cards. So I think some of that will change with what's going on in COVID and pricing with colleges, but that's certainly of concern. Our debt service has really fallen off a cliff since 07, so that's good. Folks don't have as much. Their debt service is a lot lower at 9.1% as a percentage of their disposable income, and net worth has certainly been climbing. So the consumer is in good shape. The consumer is 65% of our gross domestic product, and so they're in good shape and they have a lot of money sitting in their pocket. Back to mortgages, just so low. I mean, they're just incredibly low. And so most people are, I think there's a recent surge again, as people finished out their refinance, and rates are just so attractive for mortgage holders. We have been using our debit card instead of a credit card. So less and less is going on the credit card, debit card, because we do have cash in there. So people are using their debit card. So again, we're not getting ourselves in hock with a bunch of debt. And then our savings rate, we as Americans have never been great savers, hovered kind of around the 5% rate as a percentage of our income. But we're, up here, call it 12%. We were a lot higher. Our debt has gone down and our savings has gone up. So that's a good thing for the economy and a good thing for the market. Looking at, we have all that cash. So what does that mean? Well, you looked at mortgages when it initially dropped back in March, they are off 35%. They're now positive 26%. But you look at other areas here, credit cards are down, but hotel occupancy still down 33%. Travel still down 54%. Dining down 64%, and TSA traffic is still down over 50%. So this is possibly creating a tremendous amount of pent-up demand. So you even look at China, they're almost back to normal, whereas we in the US are not. So let's go to here. Also, the COVID vaccine is out there. That's my wife, Tricia. She's a nurse, so she was able to get her second shot. So the vaccines are coming out, and I think they're going to be coming out quicker. So that's certainly great news, and we're happy for that. That's good for the market. But then let's look here. We track mutual fund flows. So most people have not been participating in the latest US rally in stock market. Year to date, so in 2020, they were net sellers of US equities. 2019, they were net sellers, and they barely added in 2018. They got out of world equities, and they've been buying bonds and adding to cash. If you look at the cash, there's a huge amount of cash sitting in the economy. Back when CNBC had Maria Bartiromo, it used to drive me crazy. She talked about all this cash on the sidelines, but I'd love to see her right now because there is a tremendous amount of cash on the sidelines. And true to form, a lot of folks generally buy when the market's going up and sell when markets go down. So, again, another good part to the economy and good for the stock market. And, you can't earn anything on a money market account or a CD, a savings account. $100,000 earned you $200 dollars last year. So that certainly, you start talking about risk, and we would say that there's probably as much of a risk in this in having your money in a savings account at times, because it doesn't keep up with inflation. You could possibly run out of money if you're sitting at that. So we think that that is a risk. And we talked about last quarter that the TINA, there is no other alternative. And so that's why some people are adding to stocks. And I'm just going to throw this out there, not a political conversation, but frankly, markets go up regardless of who is in the market. So a lot of people decided that they were going to get out of the market when Biden came in. But I think time will show that the markets really do not care that much. And so that ties into the Senate. So the Senate is 50-50. Obviously, Kamala can sway that vote, but what does that mean? Well, major changes, gun control, regulations, you need 60 votes. So you're going to need GOP support on that. So you need 60 votes to pass a lot of that. And even if they do support some of that, even if it does go up, they would probably be tempered. It's not going to be as aggressive as a lot of people think. Now, cabinet appointments and judges and stuff like that, that is a simple majority. But that's just kind of our talk about that. A lot of people are very concerned with that as it goes into the market, but we just don't think and I don't think I think the market agrees with us. It's not as big of a deal as some would believe. So the bad, we need to get people back to work. We're still over 10 million people that are unemployed. And so that's not a great thing. They project at about, just in California, about 43% of restaurants won't come back online. They're permanently closed. So that's not great. Las Vegas, it can't run on partial. Not a lot of people there. You need it full. You can't have 50% occupancy. You have to run that. We need a lot of people coming through those casinos. A lot of people spending money, a lot of people losing. They can't run like that. So how do we get that back up and running? We need to get employment back. So you look at long-term prolonged unemployment. It's bad for your physical and mental well-being. The longer the joblessness, the more difficult it becomes to get a job again. Because you start losing skills, you have gaps in your resume, and so the concern there is that over a third of the unemployed are long-term now and rising. So that's certainly of concern. Market mania, you look at Bitcoin, you look at Tesla, they've been incredible, and so that is certainly of concern, and I'll talk about why in a second. But I'm sure many of you read this, but there's a programmer in San Francisco that has 2 password guesses left to access his wallet for about 220 million in Bitcoin. So problem is, if he blows those next 2, those coins are forever lost. And so they think about 20% of Bitcoin, because there's only about 18.5 million out there, which is about 140 billion worth is lost. It's gone. It's so when you look at all that Bitcoin, about 20% of it is it's not even there. It's gone. It's lost. So that's you look at manias. There's a lot of dollars chasing a very small, a finite amount of coin, and it gets worse as people lose passwords and there are less and less coin available. Unlike dollars, you can't keep printing them. It's a set number. Tesla, I add this because last Friday, Tesla did about 62 billion in total traded value, buys and sells. And so to give you some feel of what that means, you can see below that same day, Apple only traded 13 billion, Amazon 10 billion. So in 6 weeks, there was more traded in Tesla than, there's more dollars traded in Tesla than all of 2020 for Facebook. So a tremendous amount of Tesla is traded. And then you look at the company itself, fewer than 500,000 cars, and it bumped its market value by about 750 billion. GM sold 2.5 million cars. They have 200 billion in assets, and their market cap is at 62 billion. So currently, at the ratio that Tesla is producing cars, it would take them 1,600 years to make as much money as the stock market has invested in it. So certainly mania, We've seen them in the past. Tulip mania is all of that, and the .com mania. So Tesla. Problem with Tesla, though, it's almost like a religion. You can't get people out of it, but it's certainly, as money managers, it's of concern to us. All of these IPOs, DoorDash came out. They're valued at $71 billion. That is more than the combined value of Denny's, Applebee's, Outback Steakhouse, Dunkin' Donuts, Domino's, and Chipotle. So that's certainly of concern. The SPACs, we're seeing a tremendous amount of those special purpose acquisition companies. They call them blank checks. So they come public with no assets and then they merge in with a private company. So the problem and concern there is, do they care so much about valuation because all this money is in there? So we're seeing those. They've been around for a while, but you can certainly see in the last year, that's month by month, the rise, the return of the SPAC. So you look at a bubble, what are the attributes? Increasing share issuance. Yeah, I mean, there was US companies sold 368 billion in new stocks, IPOs, SPACs. So yeah, check. A lot of new share issuance. Heightened volatility, check. Certainly last year with a drop in March and the bumping around there. The sector or index, it doubles in price and beats the broader market by 100% over 2 years. Well, almost check. But we certainly would say that there are telltale signs that pockets of the market are bubbly. And I think that really is a certain amount of tech stocks. I think as we talked about before, there are other areas that are not. But when you do look at some of these stocks and some of these companies, they're frothy and we would consider overvalued. Other concerns, there's certainly been a trouble with the rollout. It hasn't gone as quickly as everyone hopes. Hopefully that starts moving faster. So let's just wrap it up. You look at the markets and you look where you invest over time. So, we're, I guess, coming out of the recession. So these are the different areas that do well in that time. But if you consider this our early expansion, as we start to open up again, what generally does well? It's materials, financials, industrials, real estate, IT still there, and consumer discretionary. But what you'll see there is certainly some value type of stocks. Value would be your materials, industrials, and financials. We went over the last 10 years and value just poorly underperformed growth, but there could be some potential for them for the next 10 years. You looking at the winners and losers. So work-life balance, certainly home improvement and consumer staples all did well. And so those could start moderating a bit. The great acceleration, that I'm not throwing all technology out, but technology and healthcare could continue in certain areas, especially the healthcare, which we'll show in a minute. Right for disruption, energy. I mean, that rig count, not only that rig count is low, but now all of a sudden, let's say you get your vaccine and it's rolled out and we all start taking all that cash we have sitting on the side and start taking trips. Well, that's going to be planes, that's going to be automobiles. And so we could see an increase in energy, retail. I mean, I think people would like to go possibly out to a mall and go touch and feel things and restaurants. Pent up demand, certainly travel and everything that's involved with that. So, when you get a hotel, all the dining, all the different things that go, flying, all that goes with travel. There's certainly some pent up demand there, and food service. A lot of people would like to start going out to restaurants on a more normal basis. They'll start filling up. And so all the different food service companies, food providers could see some bump. So healthcare, you look at where home monitoring devices are going. They're about 628 million in 2019. They're looking by 2024 about 31% annual growth. And so the diagnostics, all of that, telemedicine. I think the one thing COVID did was people realize that we can do some of this stuff over our phone. So that's certainly projected to grow at about 21% annualized. Netflix is going to continue, and so what does that mean for TV and TV providers and movies and all that. So if you were to take Netflix, what they're going to spend in content in 2021, they would be ranked 113th as far as gross domestic product. So they're going to spend as much as the gross domestic product of Zambia and pretty darn near Afghanistan, Iceland, and Yemen. So they're spending a tremendous amount of money. So that Netflix and that model and all that is here to stay. So what does that all mean? Well, we think the risks of the market are a continued slow rollout of the vaccine, and hopefully that starts to accelerate. Everyone gets their first and second doses, and hopefully that gets moving quicker. Certainly a reversal in tech. A lot of those big overvalued companies at some point does, people lose their religion in Tesla and a few other stocks, and that could happen. Potentially too, there could be, in this new administration, they could be tougher on tech. So we'll see there. Could inflation spike? So now all of us are spending our money to go out and fly. Delta or whoever has a bunch of planes that are sitting in the desert. They have to bring those online. So there's limited amount of planes. So they start jacking up their prices of tickets. Oil starts going up. Could there be inflation? Possibly. That prolonged unemployment. We do need to get people back and working. That mania in the IPO, the SPAC, I mean, just almost like you don't care about valuations. Opportunity, though, rates are going to remain low. As they say, don't fight the Fed, and certainly that has been a good trade over time, and they're not really going anywhere there. We talked about this last time, but the latest industrial revolution, that connection with technology and biotechnology, will continue to be an area that we think will have growth. There is a tremendous amount of cash on the sidelines. That cash will go into equities, or that cash will go into the economy at some point. As we said earlier, Americans are not good savers. That money will go somewhere. And so I think that's certainly a great opportunity. International, you look at the pricing on it, it makes sense to have international in your portfolio. And we would say, kind of in closing, if you look at a train, you want to hop on the engine, not the caboose. Everyone is chasing that last trade, trying to jump on the caboose. I need to own Bitcoin. I need to own Tesla. That train is left in some respects, and those who've had it, hopefully you're selling it and cashing in on some of it. But you look at the engine, what could be driving the next run? We think part of that could be value stocks. And again, we're not saying technology goes away, but energy could certainly be out there, and industrials and other things. Call it the opening trade as the economy starts opening up. Well, my time is done. I'm going to turn it back over to Joe and stop sharing my screen here.
Well, thank you, Morgan. Terrific job. I'm just excited that Trisha made her first debut in our market update. So she'll be excited about that.
Yes.
That's 12 years in the making. So Powell stated today that high interest rates are virtually going to go nowhere anytime soon. So Chris asks, are you overall bullish on the market for this year? He thinks with quantitative easing having no end in sight and a political party controlling the House and the Senate, and ability to pass stimulus, we are primed for markets heading north for the foreseeable future. What, if any, reallocations are you eyeing with President Biden in charge?
Yeah, I mean, part of it, generally, international stocks do well with a Democrat in the House. So you look at Biden's plan that he's going to, I don't know if he's come out yet. I haven't looked on the news yet, but part of it is he is doing a new stimulus plan he's working on right now, but it is, they're looking at money for vaccine rollout, vaccine distributions, $2,000 to people immediately, reopening schools, small business loans. So I would say, based on some of my earlier comments, that it is that the trade is the opening up type of stocks. hopping on that engine, looking at things like oil, looking at things like industrials. So I too agree. I think that the market could be okay. I think the greatest concern to me is the latter part of the market, even though it appears that earnings should be a lot better in the second half. My concern is once we come out of this haze, everyone has their vaccine and everyone's back out there, we do look and go, wow, there's a lot of people that are not working. There's a lot of places that are closed. And so that's certainly a concern. But I think the trade is the more opening up stocks versus stay at home.
Okay, terrific. Thank you. For all of our guests and clients that have joined us this afternoon, if you want to ask questions, you can raise your hand. I can call on you. You can put it in the Q&A section, or you can also add it to the chat. So I've got a couple more here. Do you anticipate a significant correction, much like Q1 of 2020? If so, is it wise to keep cash on hand for the big dip? Now, this is obviously a conversation we have with clients all day long, and each advisor in the firm has a list of clients who are holding cash at the moment. You talked about cash in great detail. So I want to give if a client came in today, say, hey, I think the markets are going to dip. Should I hold on to some cash? What's your conversation?
Yeah, if you had a tremendous amount of cash and you were just starting to invest, I wouldn't put it all in at once. I would do it over time. I don't think having cash on the sideline is a bad thing overall, but it all comes down to the individual person. I mean, if I'm, in my 30s, I'm not so much concerned with what's going on right now, but I would certainly love to have the opportunity, if there is a pullback, to have some fresh capital going to work. So I would look around, have some good quality stocks that I can look at, or sectors or funds that I can go 10 years from now, I'm so glad I own this. And then beyond that, I think a cash holding is not a bad idea.
Okay. And the last question I have now, and hopefully someone can ask a question if they have something, or we can end early, but here we go. So what is your position on the future of the next 4 years with respect to cannabis and renewable energy? What would be a good investment, like an ETF or something?
Yeah, if I was to, there's a bunch of them, but if I was to invest in cannabis, I would certainly do it through a fund, an ETF or something like that, because there's going to be winners and there's losers, and so I would be investing in an ETF. But I think whoever asked that is right. I mean, it's interesting how acceptable it is on so many levels, and compared to years ago. So it'll continue being a story, continue being an area to invest in. And so you look at cannabis, and I think if you own things, it's less about owning the farms and all those things, but more the distribution on it, because it's, as more and more companies come out, the prices are going to continue to come down.
Okay, good. What is Spinnaker's take on the recent 10-year yield hike despite near zero interest rates? Should one be concerned?
Yeah, so rates did go up from about 70 basis points. I think it's sitting at 110, 1.10 or something like that. It has moved up, and that is a big part of that is the fact that the concern over spending, the concern over if the Democrats come in and spend a lot, debt goes up. And so percentage-wise, that's a huge move. However, you look at last year, in 2019, where the 10-year finish, it's not that big of a move, but it's something, it's a great question, because it's something we are certainly watching. But it seems like it gets in kind of a range-bound area there. It's going to bump up against a ceiling there and probably pop back down a bit.
Okay. One of my favorite questions from anybody is, do you anticipate a pullback in 2021? So obviously, if we knew these answers, we'd probably be on some island with a satellite phone, but certainly you can forecast what you think might happen. I know you mentioned first 6 months could be good, second 6 months, who knows? But yeah,
I think if we have, let's say that the vaccine doesn't work as planned. Let's say that tech has the S&P, 28% of it is almost 30% is in 10 stocks. If we have something where tech just gets beat up, which it could, the market in general will go down. It will. That doesn't, and I'm not talking about market by talking about the S&P 500. The S&P 500, if those top 10 stocks get hurt, it's going to go down. That doesn't mean your small caps, your mid caps, your international are going to get hit, but the S&P certainly will. If the unemployment issue is prolonged, or if inflation jumps in, that could certainly trigger something here. So I think those right now are the triggers, and that could certainly affect the markets.
Okay, this might be our final question, but it comes from Marco Albertini, owner of the Albertini Windows and Doors. I've spoken to Marco briefly on this. I'd be curious about your comments, but basically any projection on the euro versus dollar exchange rate.
Oh gosh, yeah. I mean, the dollar's certainly been beat up recently because of the debt, and I think that could continue a bit into the year. So yeah, I think it sits where it's at. If not, the dollar continues to weaken a tad against it.
Okay. I don't see any other questions. I don't see anybody raising their hands. I think you did such a good job answering everyone's questions. Do you want to, I have a couple comments that I'll end with before I do that. Do you want to talk briefly about our philosophies as far as the ABCs of investing and kind of remind clients and those that are friends watching about how we handle that?
Absolutely. So, we try to keep it simple at Spinnaker. So it's, as you say, an ABC. So how do you become a successful investor? We believe it's asset allocation. Well, I mean, that's certainly a commodity, but it makes sense. There are some people that did well owning Tesla and a few other things, a few other stocks, and they did well. But over time, diversification, asset allocation wins, and it always has. So that's your A. The B is behavior. There are a lot of people who got out in March, and that's a behavioral finance type thing, and they certainly were hurt. You don't lose until you sell. So behavior, we like to make sure we keep you on track. And C is costs. Certainly know what you're spending on your funds, what you're spending in commissions and whatnot, because all of those, you take all of those three together, and those are really, we believe it's simple, but your keys to success.
Okay, terrific. Well, thank you. Well, I appreciate all of you being with us this afternoon. We're very excited about the growth that we're having here at Spinnaker and the terrific clients we have, and the fact that you guys continue to not keep us a secret and continue to send us friends and family and people in your community. We love that the work that we put into 2020, what we're looking forward to accomplishing in 2020 with you as our clients. A few final talking points. I just want to make sure you guys are aware. Andrew Krongold, one of our partners here at Spinnaker Investment Group, has spent a tremendous amount of time in the third and fourth quarter of last year and continuing into the beginning of this year, sealing in some relationships we have with different opportunities with our clients, and certainly some partners that we've developed. So if you guys have cash and you're looking for an alternative other than sitting in your bank account earning zero, and you're not looking to lock it into a CD, we have partnered with a company called Flourish. So if you're looking for a high yield savings option and a component that would basically take your cash and earn something better than zero, we have a high yield account called Flourish that we partner with. So you can certainly reach out to your advisor here at Spinnaker, and we can talk more about that and helping you open that account. It's a safe way to put your cash, FDIC insurance, and getting better than sitting in a bank. Also, we've developed a lot of different financial planning software. So if you're getting close to retirement, you have questions about financial independence, if you just want to make sure you're on the right track when it comes to planning, certainly reach out to your advisor. We can work with you on more of the financial planning software that we've brought onto the firm. And then also the client portal. So if you've had an opportunity, obviously you've got your Schwab login, but if you go to spininvest.com, you go to the client area, we want to make sure you've got access into your client portal. Nikki Wood, our client concierge, will be reaching out to you. Make sure you don't have any questions with that. Make sure you do get logged in. But we now have a feature where you can link external accounts. So it becomes more of a holistic view when looking at all of your different accounts, whether it's at Spinnaker with Schwab or it's outside a different account, maybe a 401k or checking account, or another high yield savings account. So it's a great way to see all of your accounts linked, even if they're outside of Spinnaker. So you can get a holistic view and get a complete view of what's going on in your financials from an assets versus liability standpoint. And then finally, we're just excited to be where we're at right now. We're excited with the growth of Spinnaker. And like we introduced our team with Nicole and Nikki and Annika and Riley and Anthony and Gerald and everyone else on the team. We're excited for 2021. We appreciate your continued support. With that, I'll go ahead and dismiss a little bit early, but we'll see you next quarter for our market review. Thanks a lot.